Good morning, everybody, and welcome to the third in this series of webinars, Investing Outside the Mainstream. On Monday, we looked at the use of illiquid investments and some of the challenges and opportunities which they offer for incorporation into managed accounts. And yesterday, we looked at private markets with private equity and private credit, and the opportunities and issues that they give rise to. Now, today we're going to take a broader perspective on the canvas of putting together managed account portfolios. And we're fortunate enough to be joined by two very experienced portfolio managers from Resonant and Russell Investments in a session hosted by Chetan Trehan from SQM Research. Chetan is the sector head responsible for alternatives and multi-asset investments. So very appropriate for today's session. Before I hand over to Chetan, though, let me just talk to you about a couple of IMAP events that we have coming up. So one of the main conferences which we organise each year is Advice in Action. This year, it's going to focus on digitalisation of advice practices. So much of what we've done, so much of what we're seeing going on in advice grows out of both AI, but more appropriately, just the increasing use of digital tools in the creation and delivery of advice. And that'll be the primary focus of our conference in Melbourne and Sydney in July, where our principal sponsor, Centric, will bring their experience of running one of Australia's largest and most successful advice practices to the conference. Ahead of that, though, and something which, if you're in Sydney or Melbourne, I'd encourage you to participate in, is our risk management roundtable. We'll have presenters from Atrium, from Millermans, from BlackRock, and from BT, talking about different aspects of risk, how they assess risk, how they monitor risk, how they manage risk in managed account portfolios. And in BT's case, how they assess the capacity to manage risk in portfolio managers. This will be a 2-hour session. And if you're involved in portfolio management, I'd encourage you to join us live in BT's offices on the 4th of June in Sydney or the 6th of June in Melbourne. And finally, the Managed Account Awards. This will be the 7th year, I think, in which we've hosted the IMAP Managed Account Awards. The categories this year: Australian equities, small caps, fixed interest, international equities, multi-sector, responsible investing, which was new last year, and then the licensee category and boutique licensee category, for where boutique licensees we define as advice practices or advice licenses with fewer than 70 authorised reps, and our innovation award. So I'd encourage you to participate in the awards. You'll get a lot out of the entry process, and who knows, you may be a finalist or a winner. So it's something which I see reflected in lots of email signatures from people who've been finalists and winners. The panelists, the judging panels, is made up of leading independent research consultants. So it really is recognition by your peers of high quality service offer. So before I hand over to Chetan, let me just remind you that we like this to be interactive. Please ask questions. I know that what we're going to talk about today covers a range of really interesting topics, and I'd encourage you to submit questions through the Q&A button. So without further ado, let me hand over to Chetan Trehan from SQM to take us away. Thanks, Chetan.
Great. Thank you, Toby, and good afternoon, everyone. I'm looking forward to this session today. Alternatives, broadly speaking, is quite an exciting topic and lots of sub-sectors within that. So we've got two great panelists, as Toby was saying, Jason Petras and Lachlan Brrumby. Jason's a director at Resonant Asset Management with over 20 years of experience, with plenty of experience within the alternative sector as well. And Lachlan is a senior portfolio analyst, multi-assets at Russell Investments. So a fair bit of exposure there to alternatives there as well. And he's worked at Lonsec in the past. So great experience there. They will be presenting for a few minutes each, which will be followed by our panel discussion and Q&A. So I would now hand it over to Jason.
Thanks, Chetan. Yeah, so hi everyone. Just today, we've only got sort of about 7 minutes I'm going to speak for, but just to sort of walk you through a little bit about the way that we think about alternatives within portfolios. We focus on quite customized private label SMAs and have some additional sort of context outside of those SMAs. So we do see a lot of different scenarios and a lot of different, I guess, uses for alternatives. So I'm going to go through a little bit about what drives that and then into a little bit more detail based on just a couple of experiences we've had within the portfolios to sort of go into a bit more detail about how we would actually build solutions. So if we could just go into that next slide, please, Chet. So I mean, really, why is it that we're looking at these alternatives and what role? And I thought one of the best things we could just start with, specific to multi-asset and building these portfolios is your traditional 60-40 portfolio that has been very much built around these long-term expectations of equity and bond correlations. That a lot of the academia, I guess, over the long term has assumed is a fixed correlation, and is actually far from the truth in that these relationships between bonds and equities are actually quite unstable, really. And so I've just put a chart down the bottom there to sort of push that point around, and we're sort of going back a fair way here, back into the late 70s and 80s, to give you an idea of what's been happening in international and domestic markets with those relationships. You can see we went through quite a long period where you had quite a strong correlation between bonds and equities, and then that shifted quite abruptly, sort of coming into that sort of late 90s period, stayed negative for quite some time, and now we've actually seen a shift back to the opposite of, particularly in the international space. So what that really means is, we're not necessarily relying on a lot of those correlations traditionally, and I think that's what drives a lot of the search and I guess the seeking of uncorrelated returns or even offsetting and hedging style strategies. So when we approach this space, we're looking very much at what are complementary additions to portfolios within your traditional equity and bond world. And that may be in a pure beta sense, but it may also be in terms of just what's driving factors to return. So are you looking for your alternatives to provide an offset or a hedging, or are you actually looking for them to be an absolute return style, sort of cash plus, or even complement your equities or bonds in a way that is sort of giving you that extra punchiness in return? So for us, what's quite key is to understand how they behave through the cycle, and then also look at the underlying instruments of what's going to be best within, whether it's a managed fund, whether it's an ETF, and then how that can be implemented. And we do get quite specific in the way we build out a solution to make sure that it has a role. And we understand how that role is being played against all the other holdings that we'll have within a portfolio. So and I've just got a couple in the next slide there. We've just got a couple of case studies, really. So I'll just sort of go through these and just give you an idea of how we've implemented these. So, we had a client that came to us with a portfolio which had quite a lot of hybrids, within it, in terms of they're using their direct hybrids. They had funds that were also having hybrids within as part of their strategy. And then they had equity holdings that were also, big four banks. So, on the surface of it, it's pretty obvious, you're sort of running quite a lot of exposure to those, to the Aussie banks, and it has worked well. We're not saying that it's not a reasonable exposure to have, but quite concentrated. So, we ran a series of risk analysis to demonstrate that, show some of the sensitivities. And then also, look at their requirement around those income targets. So, which is a lot of what was driving it. Was sort of like the key thing that they knew, was they did have that risk, but where else do they go to get some of that yield that they're looking for? So, so what we went through and did was really try to say, well, we're looking for this, increased level of income. But we're looking for more alternative income and yield strategies. So we looked at things like buy right strategies, for example, not just in managed funds, but also within some ETF solutions that you can get access to. Another example of something that we looked at and ran scenarios with the portfolio is an ETF called T-bill, which is basically a short-dated US Treasury that provides a number of really good capabilities at the moment, particularly around it's got a high running yield, it's got USD exposure, which we were looking for, gives you some defensive offsets. If you have shocks. So things a little bit that aren't maybe obvious that we're putting in there, and they actually worked really well with a hybrid portfolio, because generally when risk off, hybrids get under pressure, and you generally have rates, short-term rates being cut by central banks as well. So that worked quite well. We looked at alternative credit managers and putting them into the portfolio, but particularly around groups that had a hedging program or the ability to hedge. So it wasn't just a sort of an outright long credit exposure, and that's been quite important to us in terms of them having that risk on and risk off capability. And then in a lot of cases when we're dealing particularly with private wealth groups, these strategies tend to be a core solution, and then they're dotted with satellite allocations across PE, direct lending, a whole range of things. So we do tend to operate in more the daily liquidity type profile, but they do complement well with longer term stuff. So so that was sort of one example, particularly around hybrids, which we see sort of in portfolios in Australia probably a little bit more. Just on the next slide, then a second example where we've had more of a defensive requirement. So this group wanted to have I guess a zero or negative correlation through their alternatives exposure, and sort of in ideally they're effectively looking and happy to give up upside when the markets are strong, cash plus a little bit, but they really wanted to have some sort of defensive nature in that alternative sleeve for offsetting really equities and some other risks in the portfolio. So we looked at a number of things around currency hedging, what was optimal within that space. We did a lot of work in terms of back testing and sort of demonstrating what can and can't work. And then just looking at some quite simple exposures that actually were quite effective. They're liquid, they're pretty understandable, and sometimes it's surprising sort of how simple some of these things are. And I've just gone through a couple of examples there of what ended up in the portfolio that we used some CTA strategies, which are very good in terms of those sort of rollover markets, and we're seeing that at the moment in terms of I guess CTAs in other asset classes, particularly within the commodity space, and sort of things like cocoa is a really good example of that. Long short equity strategies that are more market neutral style, and then just back to some of the basic stuff like gold, and again that T-bill ETF worked quite complementary, and even though they're not maybe necessarily the most complex of strategies, when purposely built with the right moving parts and understanding those correlations, really came up with quite an effective alternative sleeve that ticked all the boxes. We also went through a little bit, which is sort of, I guess, a little bit of an maybe not underappreciated, but sort of like not as people may don't pay as much attention to it, but the FX hedging in your Aussie equities piece, in the international equities piece, that is quite a natural hedge for us in Australia in terms of, running an unhedged international equity exposure can be quite an effective offset to some of those risks when we get those, larger, I guess, stress periods within markets. So we do find that typically comes in around about, only a 30% hedging level is roughly what we see as an optimal. So that sort of gives you an idea of some of the ways that we think about this space and we sort of every case is a little bit different. So we're not sort of building just one portfolio, but hopefully that gives you a bit of a flavour of the way that we approach some of those problems. So that's really that's it for me. So I'll just hand back to Chetan. Thank you.
Thank you, Jason, and I will hand it to Lachlan now.
Thanks very much, Chetan. Good afternoon, everyone. So my name's Lachlan, and I work as a senior portfolio analyst here in Sydney in the multi-asset portfolio management team with Russell Investments. So we'll kick things off a little bit about Russell Investments. So started as a pension consulting firm in the US just shy of about 90 years ago. Since then, the company has evolved a lot in a few different areas, and in Australia, which is most relevant to today's discussion, we have multi-asset managed portfolios. And if we just move to the next slide, please. I'll talk a little bit about how we construct these, what's the process behind that, and then I'll move into a little bit about what that structure looks like, and then where we get our alternatives exposure and how we get that alternatives exposure and why. So looking here from left to right, we can see we have the design stage, which for each of these buckets, we have different specialized teams that are able to contribute their knowledge into each of these buckets, working in conjunction with the portfolio management team. And so at this design phase, this is where we look at what are the objectives of the portfolio, over what duration are we trying to achieve those, could be return objectives, volatility objectives, as well as other things. One of the inputs into this design phase is our capital market forecasts. And then once we have a benchmark, using the capital market forecasts to put on medium and long-term tilts. And one thing that we've moved away from a little bit is looking at mean variance optimization due to the sensitivity of the inputs in being significantly contributing to the outputs. And so if you are to have errors or estimation errors within those inputs, then the outputs will similarly have overly magnified errors in those outputs. And so something that we've moved towards is looking at risk premiums, so equity, credit, risk premiums, and duration as well. So that sits within the strategic asset allocation, the design bucket. If we then move into that centerpiece, the construct bucket, this is where we are working with the manager research team. So the manager research team across traditional investments, equities and bonds, but also on the alternative side as well, whether it's directional hedge funds, non-directional hedge funds, unlisted property and infrastructure, private credit, and so forth. And so we're working with that manager research team to then select the best strategies to be able to build the portfolio. And then on the right-hand side, on the manage component, this is where we've got inputs. We look at cycle, valuation, and sentiment, and we'll be tactically and dynamically tilting the portfolio depending on what's happening in markets as well. Very much looking for unsustainable extremes to then tilt the portfolio, whether that be adding equity risk or reducing credit risk and so forth. And so if we move on to the next slide, we'll see that we've got this a visual description of how the portfolio is constructed. And so on the far left, we've got a direct shares sleeve, about 30 direct stocks, and it's a multi-factor portfolio where each of the stocks provides exposure to one of the factors: momentum, value, quality, growth, and low volatility. And we want the stocks to have as much factor exposure as possible so that the multi-factor portfolio is being driven by the factors as opposed to stock-specific risk. And the benchmark for that direct share sleeve is the ASX 100. If we then jump across to the right, we'll see that we've got the ETFs and index strategies. So this is where we're able to get exposure to cheap beta, but also targeted as well. So whether that's more of a broad index exposure as opposed to total market exposure, being able to bring out some of the value factor exposures and things like that, or small company factor exposures as well. And then the middle piece here that has the red highlighting around it is the piece where we get access mainly to the alternatives managers. And so it's within this managed fund that's about 1/3 of the total managed portfolio that we're able to get access to private credit, some unlisted property and unlisted infrastructure, and some hedge funds as well. And what it allows us to do by investing into this dynamic core, as we like to call it, is get exposure to managers that might not otherwise be available on the investment platform due to not it being on the menu on the platform. And as well as that, within this middle piece, we're able to negotiate with the managers more attractive fees. And within the middle piece, we're also able to efficiently manage the total multi-asset managed portfolio by using efficient ways to tilt the portfolio using derivatives such as futures. And then if we just zoom in a little bit on this middle component, the managed fund, on the next slide, we'll see some of the alternative strategies that we have exposure to. And when you think about alternatives, there's probably 4 main reasons why you might want alternatives exposure. It might be for income, it might be for growth, it might be for risk diversification, or it might be for an inflation hedge. And so we can see here from left to right, we've got the most liquid on the right-hand side to the least liquid, the most liquid on the left and the least liquid on the right. And so global listed infrastructure, for example, which can be considered an alternative investment exposure, provides potentially growth, high growth, but also an inflation hedge. But also need to consider under what scenarios would it provide an inflation hedge. We sort of saw during 2022 that global listed infrastructure provided an inflation hedge as inflation began to increase. Then as inflation began to get quite high and nervously too high above what central banks were liking, they start to then increase rates, and we saw bond yields move up, which then has a negative impact on listed infrastructure as you then have a higher discount rate, and so the assets then can become valued less. Because of the CPI-linked nature of the infrastructure assets, the increase in income can also work to help offset some of that increase in the discount rate, but there are levels where rates can become too high and bond yields can become too high, which can become negative. And we can see commodities, a liquid exposure. This is where we have exposure to a basket of commodities futures within this dynamic real return fund. And so gold as a position in there has been beneficial year to date, as we've seen the gold price move significantly higher. If we kind of then look to the right-hand side, we can see unlisted property and unlisted infrastructure, which whilst you get a smoothing in the return profile and a lower volatility, if you were to unsmooth that, it would lead to correlations that are higher and volatilities that are higher. So unlisted property and unlisted infrastructure really provides the growth, but not as much risk diversification as what you might think. And then the private credit is a high income strategy that's generating about the cash plus 400 to 500 basis points, as well as that quite a consistent, smooth, low volatile income stream month to month. And then one other one I'll point out, which if we look at the bottom section of the table, we'll see in the blue directional hedge fund, which has a correlation of -0.6. And so this strategy is a long equity volatility strategy where they invest in options to get an exposure to implied volatility on regional equity markets. So both the US, Europe, Asia. And so when volatility spikes or moves from low to high, we're typically seeing traditional equity markets selling off. And so by being long the volatility, they will tend to make money in those markets when equities are moving lower. And so that's a strategy that provides diversification within the broader managed portfolio. I'll leave it there and hand back to you, Chetan.
Great. Thank you, Lachlan. So those were some great talking points from Jason and Lachlan, some good slides there. So we will continue our panel discussion now with some Q&A, and then also some audience Q&A. So as we know, alternatives is quite a broad bucket. And so let's start with a question about how do you see the changing role of alternatives since the cash rate has increased from near zero to a fair bit now, close to normal, according to some commentators, or possibly could go slightly higher. How do you see that, and how do your portfolio construction discussions and decisions are impacted by those sort of things?
I'll start, I'm assuming.
Jason and Lachlan. Yep.
Yeah, sure. So, I mean, really what's happened in the last, I guess, 18 months with the increase of interest rates, which has really been driven as a result, obviously, of inflation picking up and central banks having to try and bring that down, as we're getting high volatility in macroeconomic data, particularly within inflation. That's driving higher rate volatility, and that's driving high volatility in many other asset classes, causing a lot of dislocation. And that's what alternatives, in a lot of cases, particularly trading-based alternatives, such as hedge funds, they thrive under those conditions, and that throws through as well to active managers in general. So we think from that perspective that the opportunity sets for active managers across the whole spectrum, particularly within alternatives, should only be getting better and getting more interesting. So it also creates, in the case of like certain instruments, because you've got a higher interest rate now, you've got higher, I guess, effective reaction occurring within a lot of those spaces. So and sometimes it works differently within volatility markets because they price in a different way. But there's just a lot more opportunity within that space, and we think from an absolute return point of view, active hedge funds, etc., are going to be really in a richer hunting environment for what they do now.
Yeah, I think it's an important point as well about, whilst the cash rate higher, bond yields are higher. If we look at what bond volatility has done over the past year and a half, and the correlation it has exhibited to equities, which has been quite high, are you getting that sort of return profile that you might sort of just think and expect, and probably not? And so whilst the saying went from there are no alternatives to now there are reasonable alternatives, those reasonable alternatives, if you are buying a longer dated bond to lock that in and hold that yield to maturity, you're then obviously exposed to the interest rate risk and the sensitivity there as well. On the flip side, cash is obviously yielding a much more attractive level. But again, cash is much higher than it was. In a year or 2 years, where will it be? Who knows? But there's a good chance it could be lower. So some of the alternatives products, if it's an absolute return strategy, typically they're trying to generate cash plus. If cash moves significantly lower, they're likely to still be getting more than cash, but in totality, a lower yield. Something we think is interesting is commodities, and so that's, I suppose, not only just because interest rates are now higher, but because of the macroeconomic backdrop that we're currently seeing, where whilst inflation has been cooling and it's been a little more sticky now, we've had a couple of prints in the US that have come in above expectation. We've seen gold do particularly well, even when bond yields have been increasing year to date, which has been an interesting dynamic, because typically you'd expect that if you're getting real yields increasing, then gold, that wouldn't be the best backdrop for gold, but gold has been doing very well. And perhaps one of the drivers for that is a lot of the central bank buying of gold. And so gold can also be an interesting diversifier in the portfolio under the sort of conditions that we currently have at the moment. Something else maybe I'd mention as well is unlisted property and unlisted infrastructure. And what we've seen there sort of play out over the last year, especially as rates have increased, is needing to get an expansion in the capitalization rate. And so that has been a headwind for some of the valuations of the assets. However, some of the assets that have very high occupancy rates, it's meant that they've been able to grow their rental income along the way, especially some of the office buildings that have had high ESG credentials. And so that's helped to sort of dampen some of the cap rate offset that would otherwise have to be entirely driven by the property devaluation.
Yeah, some very interesting points there. Gold has been very interesting, like you said, Lachlan. Have you noticed your team being more interested in gold in the last 12 to 18 months? And are you getting a bit more client demand or client focus as well on gold?
Yes, I think our interest hasn't necessarily increased significantly. It's sort of a hedge that we've had in the portfolio for a little while. But on the client side, interestingly, I think that there has been a bit of a pickup. So you start to see also other precious metals, people asking about silver, for example, which sort of lagged that rally and just started playing catch up a little bit, and asking about what are some ways to get silver exposure. I think as well, potentially some of that is that as you see commodities or stocks or whatever it might be, asset classes perform really well, people start to become more aware of them and are more interested in them as well. And so sometimes I think that can be a driving force for some of the queries that might come up.
Yeah. Quick thoughts on gold, Jason?
Yeah, so I mean, gold's been a position that we've been holding in a lot of our portfolios and also in our headline portfolios for quite a while now. It's obviously done very well recently. Where that sometimes becomes a little bit tricky with certain portfolios is where you've got an income focus or sort of quite yield focused investor base. So in that case, we sort of tend to move to that T-bill or just some sort of short dated instrument within the fixed income markets, which has the advantage it pays a yield. So now that can tend to be quite reactive, but you don't have as much protection in there against the longer term extreme inflation and hyperinflation type scenarios. And then also those obviously there's a floor to what interest rates can get cut to zero basically, whereas gold has that ability to keep going. So it is like a very powerful hedge that has worked on a lot of those scenarios when you go back through those really long-term type back tests. So we're big advocates of it and don't really see where we'd be reducing that anytime soon, given the inflation environment we're dealing with.
Yeah. Okay, great. Another topic I'd like to talk about is defensive alts versus growth alts, because different teams, different portfolio managers and different dealer groups have slightly different rules around those, how to define defensive and growth and which bucket do they go to within that 60-40 or 70-30 portfolio. So do you want to give your sort of quick thoughts on that, Jason, and then Lachlan?
Yeah, I mean, look, this really just comes back to case by case basis. We deal with different, whether there's a 50-50 split between defensive growth. What we typically do is really approach it as, that's within obviously your SAA and your benchmarking, but we look to give ourselves, the flexibility within a mandate to move between them. And we try to look at alts as alts. We don't really try to bucket them as a defensive growth mix. Unless we need to. What it really comes back to for us is what is the purpose that you're looking to achieve by having an alts allocation in there. And again, as I said in my sort of earlier slides, is this about having an absolute return focus? Is it about having some sort of defensive nature to it? Is it actually an outright hedge that you're looking to achieve? So we are much more of a case by case basis, and we don't think there's a right answer to this, because everybody's going to have a different need or want within their strategies. So I'm probably sitting a bit on the fence with that one, but we don't sort of really try and bucket in that pure sense.
Yeah, sort of similar here, because I suppose at the end of the day, whether you classify it as growth or defensive, that classification isn't going to change the way that it performs in the portfolio. So probably more importantly is looking at, under different scenarios, how that alternatives strategy, both in isolation but also in the broader multi-asset total portfolio consideration, will perform. What's the purpose for the alternative exposure you're looking for? Is it income or growth or risk diversification or inflation hedging? And then how does it perform? There are probably some strategies that are more obviously growth than defensive, and some that probably fall maybe into a bit of an overlap. So, a private credit strategy that is more middle market lending to companies that have higher EBITDAs and lower leverage might be considered more on the defensive side, but you could still be arguing it's growth if they're yielding 9 to 10% per annum. Whereas the Amundi long volatility strategy that we invest in would consider that to be more defensive because of that defensive characteristic that it plays in the portfolio.
Okay, great. Thank you. Let's talk about how you and your team do research on the fund managers within this broader space, and what sort of criteria do you look at from a qualitative assessment, but also a little bit about the quantitative assessment of the performance of a fund, what sort of ratios, for example. If you want to talk a little bit about that, starting with Jason again.
Yeah, sure. So, I mean, I'll sort of split these a little bit into sort of two categories quickly. So, obviously, we're dealing with something like, gold as, sort of relevant one, and we're using an ETF, for example. It's really just pulling apart the ETF and making sure that that's being managed, properly by a good provider, and it's got, all the functionality and governance around it that we know that it's got liquidity, it's got a good market maker system built around it, and we can access what we're getting, and it's very pure. So that's sort of that side of things. Once you move into managed funds, obviously there's a whole ream of considerations. Pushing aside, the fact that it's, under a, correct structure and access, etc. Liquidity is obviously part of it. But really, when you start talking about going into the strategy, these are complex strategies. There's a lot of moving parts to it. I worked in hedge funds as a portfolio manager for 10 years. So we really try and get to the teams and understand what it is that they're doing. We make sure they've got the systems and the tools to implement their strategies. And I think one of the key parts is making sure that those funds and those businesses are reinvesting back into their process, because that is the most competitive space within the market, within active trading, and making sure that they're reinvesting and not really resting on past glories is super key to making sure that they're going to perform going forward, not looking at what they've done historically. So, because you can very quickly get overtaken by your competition in that space. So when we're talking about long short managers, when we're talking about CTAs, when we're talking about anything that's sort of like maybe a quant style investing strategy, and even people that are using sort of like specialized networks, etc., specialist credit managers, they really need to keep on top of their game. Pulling those apart and assessing them, we run a attribution, or what we call a forensic attribution process. It basically strips out their returns and it looks at where they're making their money, where they're doing a good job, where they're not doing a good job, where we can explain where that return is coming from. And then the bit that we basically can't explain where it's coming from, that's manager skill, and that's genuine alpha. So that's a rare commodity, and we obviously try and look for that where we can, when it's appropriate. So I did notice on the chat there was a question about fees. Look, ultimately we look at fees within this space as a total, like what are you getting net of your fee? The cost is a factor. Obviously, you've got to be sensible about it, but for us, we look at things net of fee, net of performance fees, whatever it might be, and we think that's justified, especially when you're dealing with genuine manager skill and alpha within the space. Then we want them to be obviously compensated, because generally we find the good ones are then reinvesting back into their own processes off the back of that fee to retain their edge.
Yeah, Lachlan.
Yeah, so I think on the manager research side of things, definitely the team, the investment team's very important. What's the investment skill and experience and tenure, the turnover of the team? How do they appear to work together? A lot of that is sort of a qualitative assessment. So meeting the team in person, having multiple meetings, can be a good way to get comfort either way, but in your conviction as to what that looks like. I think that on the quantitative side, we have a system called Explorer that we're able to use, and we're able to sort of dissect a lot of the returns from different managers, and then look at that through time, and also sort of compare it to different factors to see how it's correlated to different factors throughout time as well, to then have the lens of how would this strategy look and perform if it was added into the multi-asset portfolio, for example.
Yep, thank you. Some great points there. And just to add to that, we at SQM Research, of course, do reports and ratings on several alternative funds, and within that sub-strategies as well. And absolutely, like you both said, dissecting the returns is important in terms of what's luck and what's skill. The manager meetings are important. We always make sure we asked the right questions there, and the quant analysis as well. So yeah, there's plenty to look at in those areas. We briefly talked about liquidity, which is a very important factor, I guess, because there are sort of illiquid investments held by certain portfolios, but certain portfolios are constrained that they can't hold too many illiquid funds or strategies. So let's talk briefly about it in terms of client risk profiles or preferences, and how do you think about liquidity, Jason?
Yeah. So I mean, look, within our SMAs where we're building anything, I mean, generally it's going to be a daily liquidity instrument or fund that we're using, and there's that's sort of what we try to stick to, because we want our SMAs to have that daily liquidity profile. But in a lot of situations, what we'll have is we might be working with a group that uses that SMA as a core within, and then we'll have satellites dotted around it. So there could be something specific they're working on within the alt space. Everything from private equity, cap call structures, it could be even structured product. There's obviously it's a huge universe. But yeah, we try and very much within the SMA stick to that daily liquidity, which sometimes does have us moving back into why we might be looking for something that's got particular profile, where we're then sort of moving maybe back in the ETF world to use something which is more stylistic factor, smart beta, or particular thing like gold ETFs, etc. So but again, case by case basis, and yeah, it's like leaning towards that daily where it's generally achievable. So.
Yeah, I think
Lachlan?
Yeah, I think for the end client, if they are taking on the illiquidity risk, there's definitely the advisor would have the best and deepest understanding of both their clients' appetite and need for whatever that strategy might be. At our managed portfolio level, where we invest into the managed fund, the sort of dynamic core, as we call it, that structure, that managed fund that we invest into, takes on the illiquidity risk. And because we manage that internally, we're able to manage the illiquidity risk of that strategy as well. So the resulting sort of impact is that the managed portfolio, the multi-asset managed portfolio, still has daily liquidity, and then some of the illiquidity that the managed fund dynamic real return core has, we're able to look after. And the sort of way that we're able to do that is by having a relatively low maximum illiquidity, and then have an even lower internal maximum. Make sure that you're always below those, having an independent compliance and governance structure internally, so that's always sort of front of mind, and there's independent sort of internal reporting that occurs on that side of things as well. Because one of the challenges at this sort of managed portfolio level is obviously, some platforms can, but a lot of platforms are not able to have sort of line items in those models that don't have the daily liquidity. And so in the structure that we've created, we're able to get the end investor some exposure to some of the alternatives that have less liquidity, but in a way that they're personally not giving up their liquidity.
Yeah, important points there. And as we know, through the platforms or through sort of regular balance funds or growth funds, there are some constraints on liquidity, whereas the big super funds, for example, don't have those constraints, and they can hold various kinds of illiquid assets, including private equity, private debt, direct property and infrastructure, for example. So there are plenty of things on that liquidity angle to think about. Right. Okay. So let's have a quick talk about private debt funds, because we at SQM Research are seeing plenty of new private debt funds, credit funds coming into the market, and being rated as well, of course. So what do you think about them? How do you think about them in terms of not just return profiles, but risk profiles? The experience of the managers that are coming in. What are you seeing there? Let's start with Jason again.
It's quite a fascinating space, and we do spend a reasonable amount of time lately looking at this, because there is definitely client demand. There's product coming in. I guess I'm going to probably discuss more things that we think people should be looking at. It's not something, again, given the liquidity profile of a lot of these sorts of funds, they're not something that we necessarily would be putting in an SMA that we're building. But we do get asked about them. We do sort of some independent papers, also just papers for clients on them, and sort of briefing notes, etc. So track record is a big part for us to understand what, how long the manager's been around doing, that sort of strategy. We do find that there's quite a few that, interestingly seem to have only just, sort of popped up in the last, sort of since 2011, and haven't been through a full cycle. So we always, suggest that people have a good look at, those histories. We think that there's definitely liquidity profiles in there that you want to, fully understand. And really, really get an appreciation for, if there were issues within that market structure, what are the rules around redemptions, and what sort of gating mechanisms do the vehicles have? That's quite key to understand that, and really then in your investment profile, factoring that in a worst case scenario. So that's I think something you sort of we say to people, everybody's happy with the wedding, but it's the divorce that everybody needs to plan for. So when it comes to the paperwork, so that's something that we really encourage people to look into. And then just generally, like, don't get I guess drawn into arguments around volatility of return. So this is a bit of a bugbear for me, to be honest, that the private debt space, in terms of when you're looking at realized returns, and I've seen this on charts a number of times, they look like they've basically got realized volatilities very similar to basically a term deposit, which is close to zero. We know that that's not the risk profile. So don't try and optimize something. And I think most managers will be quite transparent about that's actually, we've got more credit risk and we've got other factors you need to consider. But don't just look at that and say, oh, this is a really super low volatility investment. There are other things that are going to happen in there if we actually have some sort of market event, or that, we get stress in that space. And you've really got to try and go back further through time to see comparables and what happened in other market scenarios, where you can actually start to extrapolate forward how that may behave under certain scenarios. So we sort of push that point quite a lot, because when you're just dealing with a short time frame of observed performance, it's difficult to really appreciate the risk of an instrument like that, or a fund like that.
Yeah. Lachlan?
Yeah, I think that last point that Jason made is definitely a really good point. Especially looking at the historical returns, and if you then extrapolate that forward, definitely not the right way to go about it. And it's a similar thing, if you had a private credit strategy and you were looking at a mean variance optimization, for example, it would probably, without restrictions, it would probably allocate the best part of 100% to the strategy. Obviously not practical, and there's illiquidity and so forth. But there's other ways to unpack the historical return stream, like statistical ways to unpack it, and also different sort of measures that you can look at. Like, instead of looking at value at risk, you can look at mean conditional value at risk, and different ways to, when you're putting things together in the portfolio and looking at risk measures, to be able to consider it so that it paints more of an accurate picture than what the smooth returns looks like. I think another thing is sort of similarly to equity strategies, listed equity strategies. You might have a deep value manager, a high growth manager. Their return profiles are going to be different. Their sensitivity to factors are going to be different. And whilst in private credit, you probably don't have that sort of deep value growth kind of dynamic, you definitely have different private credit strategies that are trying to achieve quite different things, whether it's more distressed corporations they're lending to, trying to look for that turnaround, or whether it's real estate or mezzanine financing, or whether it's more middle market and things like that, will then also depend upon how many underlying sort of credits are in that portfolio. What sort of yield are they trying to generate? What are the underlying corporates, if it's corporates they're lending to? What's the leverage look like of those corporates? So a lot of things that you can kind of need to consider, and sector exposures and so forth, to get an in-depth understanding of what the product is like, what the risks of the product look like, and then definitely the team and the experience the team has within that type of investing is really important.
Yeah. Thank you, Lachlan. I think I've addressed most of the Q&A within my questions as well, and conscious of time. So, Toby, what do you think?
Look, thank you very much, Chetan. Jason and Lachlan, that was a fascinating set of discussions about the opportunities and the issues that using alternatives within managed account portfolios gives rise to. I mean, one of the questions that I guess I had as I was listening, and a lot of the discussion focused on SMAs. I've got a disclosed interest in the managed discretionary account area, and so I guess for Jason or Lachlan, to what extent do you think MDAs represent an opportunity to make broader use of the sort of less liquid options that can occur, that you can get access to in the alternative space.
Yeah, Toby. I mean, absolutely. I mean, and that was what I was sort of saying. We obviously build within our within our constraints and in our sandbox. But when that is being run, in a broader MDA structure, then you have the ability to dot out those satellites around around that. So the flexibility is there, the technology is there, the access to investments is there to do that. So and I think the worst case scenario, and it's interesting that this hasn't really necessarily been tested. I was actually discussing this with one of the platforms the other day, and it's a little bit of an up in the air question that if you did actually fill an SMA with too much a liquid or a level that was locked, you actually do have the risk that you could actually have the entire SMA would basically need to be sort of deconstructed, because you could actually make an argument that, well, if you've got a piece in there that can't be liquidated, then the rest of it can't be liquidated. So managing that liquidity profile of your various different underlyings, in a smart way, I think is actually quite important to do. But it's probably a little bit different in Australia because it's the single client obviously has that SMA MDA structure, but it's still something to be quite aware of. And I think it's you're probably better off trying to at least be aware of what those restrictions are, and keep, like I said, keep in mind for worst case scenario on some of this sort of stuff. But yeah, it definitely gives you the
particularly at a time like this when the markets are as they are, that seems like and I guess Lachlan, one of the things which as I was listening to you, particularly at the start when you mentioned Russell's antecedents, so to what extent does the sort of global exposure that say a Russell brings to managed account construction in Australia, to what extent does the sort of global exposure to alternative managers play out in or create opportunities in Australia?
Yeah, it's probably twofold. So the first part would be by having the manager research team that's a global team that is covering products that are both in Australia and overseas. Some of those strategies that are favourably ranked, if we want to invest in them when we go through our investment committee process and everything else, we can do that. And the other sort of ability that dynamic call plays is that if a manager overseas in the alternative space didn't have a local managed fund or unit trust, but only had a UCITS or something like that, then we're able to access that through that dynamic core if it wasn't otherwise on the platform. And so Amundi, the long volatility strategy, is an example of that within the managed portfolio that we have.
Right. Chetan, what that means is that you should be talking to Louis about the opportunity to travel overseas for conducting research. I think sort of a Monaco visit or or Tokyo, if that's more to your taste. That sounds like a necessary requirement.
Always a good point, Toby. I did go to London and Paris about 18 months ago for SQM on the best of breed trip. So yeah, looking forward to another trip sometime too. It's either a separate trip or a best of breed. Important to travel.
Yes. Yeah. All right. Look, thanks very much, guys. So let me just remind you of the couple of things which we have coming up over the next month or two. The risk management roundtable. We'll be looking in detail at the management of risk. It's identification, its management, its monitoring, with some really excellent presenters who focus very much on managed accounts and risk management components. Advice and action in July, and of course for those of you who are portfolio managers, the opportunity to take part in the Managed Account Awards this year. So thanks very much for joining us today. We'll look forward to you all taking part in further portfolio and further IMAP events. To Chetan, Jason, and Lachlan, thank you for your participation today.
Pleasure.
Great.
Thank you very much.
Thank you all.